Alright, welcome to this stock trading course for beginners, and if you're a complete beginner in the stock market, then you'll be able to go from a beginner to knowing the basics and build a solid foundation after attending this course, okay? So you might not care about this, but just a quick intro about who I am. So I've graduated with a degree in banking and finance from Nanyang Technological University, and then I went on to represent my university to rank number 1 in a Singapore Nationwide Trading Championship. I got bored with it, then I went and joined an Asia-based trading competition. Then after that I got bored with it, then I went and joined an international trading contest and managed to rank 10 out of 3,000. And a lot of times what I do is that I go around and teach people how to trade and invest, and I mainly do it in Singapore, Malaysia, and sometimes Thailand, Vietnam, and Hong Kong. So enough about me. Alright, so let's get into the agenda for this whole entire course. So we're going to talk about the introduction of the stock market, okay, just to share with you the basics and the type of stocks. Then after that, I'm going to share with you how to make money trading stocks. Make sure you have your pen and paper ready for this course. And also, we're going to talk about stock prices and trading volume, okay. Then right after that, I'm going to share with you a little bit about technical analysis, price action as well. And also, after that, we're going to talk about stock brokers, the different types of brokers. Then after that, I'm going to share with you the different types of orders, followed by indices and ETFs. Right after that, I'm going to share with you how to find stocks to trade, okay, using a free tool, free website. And then after that, I'm going to share with you a very simple stock trading strategy that you can use immediately. And it's called a retracement stock trading strategy. So sorry for my line, okay. Okay, just pause and read this disclaimer. Alright, so let's get into the introduction of the stock market. Alright, so basically what is the stock market? It's also known as the equity market, and some people call it the share market. So when some people say, I want to buy 10 shares, 15 shares, it's basically the same thing, okay? I want to buy this stock. Basically, there's a marketplace where companies list their shares so that they can raise capital. So basically, when the company decides to go public, their shares would be listed for trading and then be available for everyone to trade on the exchange, okay? So basically, what are shares? Like I said just now, it's also known as stocks, equities, and when you read textbooks, a lot of times they refer stocks as securities, and it represents partial ownership of a company. So when you buy a share in a company, you are a partial owner of the company. The more shares you buy, the more control you have over the company. If you only buy 1 share, 2 shares, you're only a very small owner of the company, okay? So shares are listed on a stock exchange, which provides an organized marketplace for buyers and sellers. So if you buy a share, that makes you a shareholder or investor. And being a shareholder, you get a couple of rights like voting rights. And like I said just now, the more shares you buy, the more control you have. So basically, companies, they issue shares to raise money, and then investors, they'll buy the shares in order to participate in the success of a company. So if the company does well, then we all earn money from it, okay? And the other thing is that stock exchanges, okay, is like a marketplace, like a supermarket, where members will meet and then buy and sell stocks on the exchange. But because nowadays a lot of things are electronic, most of the things are done online, okay? And the thing is, being a shareholder doesn't mean that you can become a boss of the company, because if you buy 1 share, 2 share, it's just too insignificant. You need to buy millions and millions of shares in order to have a say in how the company is run, okay? So back in the days, a lot of people used to meet in the trading floor of a stock exchange, for example, New York Stock Exchange or Nasdaq, to buy and sell stocks. But nowadays, like I said just now, everything is done online. Most of the things are done online. And New York Stock Exchange, normally they would list blue chip companies, the larger companies, because their listing requirements are quite stringent. But when you look at Nasdaq, it's a little bit less strict when it comes to listing companies there. Nasdaq are mostly tech stocks, and more than 12,000 stocks are traded over the counter, OTC, and these are mainly small companies, okay? Just a side note for you. One very important thing when it comes to being a stock investor or trader is understanding ticker symbols. So if you trade Forex on the charts, let's say you're trading yen, is listed as JPY instead of Japanese yen, the whole entire word. So to make things simple, stocks is listed in the same way on your trading platform. So when you type in, let's say, KO on the search bar of your trading platform, then you see your Coca-Cola stock chart. And then when you type in AAPL, then you see the Apple stock chart. But you don't need to memorize the ticker symbols because sometimes the letters are a little bit weird. How come cola is KO instead of CO? You just type in the company name and then the chart will appear, okay? But over time, when you become more experienced, you start to so-called memorize, remember the ticker symbols. Oh, Apple is APL, then Coca-Cola is KO. Okay, so some other terms that you need to know, the basic terms, is initial public offering, or in short, IPO. Basically refers to the first sale of a stock to the public for the first time. Okay? And normally, at the start of the stage, it is sold to large institutional investors rather than to the general public. So, as a public retail trader investor, we will tend to get in a little bit later. So it means that the price are not that favorable as compared to the price that's gotten by institutional investors. So they sold in the primary market, mainly for institutional investors. So when it comes to the markets, there's a primary market and secondary market. So everyday trading by retail traders, it takes place on the exchange, meaning it is on the secondary market, okay, that's available to the public. So the retail brokers, they operate in the secondary market. Whereas if a private company, if they want to issue shares to the public, they want to become a public company, they are going to approach an investment banker instead of a broker to help them turn their company from private to public. So to put in simple terms, the primary market is a place where shares are created, whereas for secondary market, it's a place where shares are traded publicly. Okay, so the next term that's pretty common is shares outstanding. To put in simple terms, it's the number of shares that has been issued to investors and company executives. So let's say when you're trading a stock like McDonald's, okay, they have like 700 plus million shares outstanding. Think of it like they have 700 plus million slices of pizzas, and then each of those pieces is valued at the current stock price. So let's say if you look at the chart and you see that McDonald's valued at $150 per share, then that is the price per pizza slice, okay? So another common term is market capitalization. To put it simply, it tells you how large a company is, okay? So a lot of people say, do you want to buy large cap stocks, medium cap stocks, small cap stocks? To put in simple terms, large cap stocks refer to big companies, established companies, blue chip companies, whereas for small cap stocks, they are like the smaller companies, okay? But then their potential for growth is a lot more as compared to the super big companies. So it refers to the market value of a company in terms of its outstanding shares, okay? The key term, market value. So basically, the way to calculate market cap, okay, to see how large a company is very simple. Just take the latest closing price times the shares outstanding. So let's say if I go to investing.com, okay, and then we have the Walmart stock over here, and you can see that there's many information over here. Just ignore those for now. And what I want you to take a look at is the shares outstanding. You take this number, shares outstanding, times the previous close, and then you get 397.62 billion market cap. Okay, so the next very important term is bid-ask spread. You need to know this so that a broker wouldn't be able to take advantage of your ignorance. You need to know this so that you know that you are with a good broker that's not here to scam you. Okay, so to put in simple terms, it is the cost of trading. Each time you open a trade, you need to pay the bid-ask spread. So basically the bid is the price at which someone is willing to buy the stock, okay? And ask is the price at which someone is willing to sell the stock. And when you, as a retail trader, when you buy, you're going to buy at the ask price, which is higher than the bid price. And when you short sell a stock, you're going to short at the bid price. And the difference between bid and ask is how brokers make money, which is the bid-ask spread. Okay? Make sure you pick a broker that has a good spread, and also make sure you trade the liquid stocks, because the more liquid a stock is, the less the bid-ask spread. Same thing for Forex and other markets too. And never use market orders on illiquid stocks. Or better yet, as a beginner, don't trade illiquid stocks. Because when you place a market order on an illiquid stocks, you might not get the price you want. In fact, the price that you get might be very far away from what you want. And how do you know whether the stock is liquid? You look at the average volume of a stock. Go back to investing.com. You can use a lot of other financial websites, okay? Generally, I will make sure that the average volume is more than 1 million. Okay, so if you want to filter out stocks, this is one of the criteria. And generally also, liquid stocks, they have a spread of a penny or two. Anything more than that, then you need to be suspicious. Okay, so let's talk about the type of stocks. So the first type of stock is common stocks, which is the more common one among traders and investors. And when you buy common stocks, you have voting rights. Whereas if you buy preferred stocks, you have no voting rights. But when the company decides to pay dividends, you get the dividends first. So there are pros and cons of each type of stock, okay? So this is very important. You need to understand the factors that move the stock market. The first one is technical factors. Then the second one, fundamental reasons. So poor earnings or good earnings from a major big company can actually affect the entire market. And third thing, global macro factors, okay? Global macro factors affect stock market, forex market, commodities market, because nowadays markets are interlinked to each other. If you study inter-market analysis, you understand what I'm talking about. And then economic indicators, major indicators like inflation, deflation, the stage of the economic cycle, employment numbers, all these are going to affect the stock market and also determine which stocks, which sector of stocks are going to go up, which sector are going to go down. Then also breaking news, let's say an unexpected event like pandemic is going to affect the stock market as well. Of course, this can also be tied to global macro factors, because a lot of global macro factors, some of them, they are unpredictable, okay, like wars, pandemics and all that. But of course, the most important thing you need to know is that ultimately what really moves the market is market sentiment, because it is how traders, investors perceive all of these events, all of these factors, how they perceive it. This is going to determine whether the markets are going to go up or go down. Basically, the public's perception about the company. So that's why nowadays sometimes, even though companies they are already very famous, they still spend a lot of money on advertising, because when a company gets good publicity, then their stock price is going to increase. Okay, so basically, how to make money trading stocks. So this is the most common one when there's a bull market, okay? The market is going up. Okay, there's a nice uptrend. Then you can go long on the stock market. Okay, then you can go long on the stock market. There are many different trading strategies, one of which is momentum trading. A lot of traders, they would buy high and then sell higher. And this is not a recommended strategy for beginners. Okay, later I'm going to share with you a strategy that is more suitable for beginners. And the other way that you can make money in the stock market, okay, is to short a stock. So you sell a stock here, let's say for example, and then you decided to buy back the stock over here, and then your profits would be this amount. Okay, so when people talk about short selling, this is what I mean by that. You sell high and then buy low. This means that you can make money either way, when the market is going up and also when the market is going down. And there are two ways you can go about it to profit from stocks. The first one is short-term trading, which is probably what you're looking for since you're attending this course. Holding period ranges from hours to weeks. Okay? And the other way of doing it is through long-term investing, and your holding period often goes up to a few years. Okay, so for beginners, which one should you pick? Or even if you're experienced, which one should you focus more on? I would say take advantage of both. Even though both requires different skills, one more of technical analysis, the other one long-term investing, more of fundamental analysis. If anything, be more of a long-term investor than trader. Yes, you can trade, but then as you become more experienced, put more money into investing because you want to let your money work hard for you. Because for traders, we gotta trade every single day, almost every single day, and we are kind of like working for money. Whereas for investing, you just do the work upfront, put in the money, then let the money work for you, take advantage of compound interest. Okay, so for stock traders, the focus is on the short-term volatility and price movements to make money. And long-term prospects of the stock is not as important. Of course, we still need to look at certain numbers to increase the probability of our trade, okay? But for traders, you gotta rely more on technical analysis than fundamental analysis. With that said, you still gotta look at fundamentals, okay? The best traders that I know, they combine both together. And holding period ranges from minutes to weeks. And as a trader, you gotta check your stock trades every single day, okay? So some very successful stock traders in the past is Jesse Livermore. You should read his book called Reminiscences of a Stock Operator. It's a very interesting book, and he's an American stock trader. His net worth 1.5 billion. Main strategy, he look at pivot points, and also he does trend trading, and he tries to avoid the ranging markets. Of course, he adds this with volume analysis. Because, for example, when a stock breaks out with high volume, the chances of it working out is going to be higher as compared to if it breaks out at low volume. Okay, so for stock investors, they focus on the intrinsic value of the company. So whether a company is overvalued or undervalued is relative, okay? Because it depends on the current stock price as compared to the intrinsic value. So for the calculation of intrinsic value, I'm not going to cover in this stock trading course. But if you want me to do a separate stock investing course, let me know, okay? Where I'll show you how to calculate intrinsic value. And the short-term fluctuations are not important to them. Not important. So for stock investors, they will tend to monitor their stocks once a week or once a month, and that's enough. Because no matter how great a company is, the stock is still going to go down in the short term due to fear and greed. And stock investors, they rely more on fundamental analysis as compared to technical analysis. But with that said, stock investors still need to rely on technical analysis for them to enter at a good price. Whereas for fundamental analysis is to determine the long-term direction of the stock. So the holding period goes up to a couple of years. And of course, one very famous value investor is Warren Buffett, okay? And he's the CEO of Berkshire Hathaway. You can actually buy stocks of his company, and his net worth is 112 billion USD, and his main strategy is value investing. And he tends to buy more conservative companies like insurance companies and banks, and he rarely buy tech stocks. And despite being so rich, he's not even flashy. He still drives a pretty normal car for a billionaire and lives in a modest house. Okay, so how can you buy a stock? Fundamentally, stocks are bought and sold in stock exchanges, like I said earlier, at NYSE, New York Stock Exchange, Nasdaq, and London Stock Exchange. But for traders, nowadays, because everything is online, you just need to open an account with a broker to get a brokerage account. And how do you pick the right broker for you that is not here to scam you or just to take your money, take your profits away? Later I'll share with you how to pick the right broker. Okay, let's talk about the stock prices and trading volume, just to give you an introduction of it. Okay, so when you come to a stock chart, you can use any platform you like, but this is TradingView. You will normally have a ticker symbol, okay? So let's say we are looking at Apple. The short form of it, the ticker symbol of it is AAPL. And normally Nasdaq stocks have two symbols, like Facebook, FB. So you can understand that as a stock trader, we are trading the short-term fear and greed. No matter how good a company is, in the short term, it might go down for a while, and this is driven by fear and greed emotions. In the long term, the stock will go to its intrinsic value, okay? So along the way, you might have a long-term bullish trend. You might have a long-term bullish trend, but along the way you would have temporary retracements, which is normal. And if you use retracement strategy, this is a good time to enter, and then you can get out after a couple of days or within 1 day, okay? And whether you're a commodities trader or forex trader, you need to know that the stock market is a leading indicator of the economy. Because during the pandemic, what happened was that even though the economy is in a bad shape, but then stock market recovered, so it is in a way telling you that, okay, the economy is going to recover soon. Same thing for 2008 financial crisis. In early 2009, the US economy is still in a bad shape, but then the stock market recovered. People are still losing their homes and then they are getting laid off, but then stock market still went up. So it tells you that, okay, an economic recovery is on its way when the stock market goes up first. And don't wait until the news to tell you that the market is bullish right now, because by the time the news announce it on CNBC, Bloomberg, it is already too late. So sometimes you might realize that a company may announce good earnings, but then the stock price still fall. Why is that? Because traders, they are reacting to statement from the management, which is not so good, and hence it will be priced into the stock, okay? Of course, the norm can also happen. A company can announce great earnings, and then the stock price will gap up the next day, because institutional traders, they are buying up the stock. And sometimes this might even cause the stock to go up days and weeks on end, okay? If you skip to this part directly, you can stop watching. But if you didn't, then we'll continue. So 2 common ways to analyze the markets. The first one is fundamental analysis, then the second one is technical analysis. Because we are talking about trading now, so I'm not going to talk so much about fundamental analysis, because this is what long-term value investors focus more on. Of course, as a stock trader, we still need to look at it, but not as much as compared to technical analysis, okay? Okay, so to put in simple terms, when you look at a stock chart, or any chart, forex chart, commodities chart, you would have a bullish trend, sideways trend, meaning it's going sideways, or a bearish trend. So of course, in a bearish market, most investors and traders, they are going to be very fearful. So if you're a long-term investor, a lot of investors, they are going to sell off their stocks out of fear, which is what you should not do as a long-term investor, because when people are scared, a lot of times we can buy the stock at a good price, provided that the intrinsic value is a lot higher. Whereas if you are a stock trader, then some traders, they are going to short sell, so they're going to sell the stock at a higher price, and then when the price goes down, they're going to buy back the stock, okay? So this is a bearish market, and then the blue color portion over here is the sideways market. Some people call it consolidation market, some people call it ranging market. It's the same thing, okay? During a sideways market, you can choose to trade the pot resistance, okay? So some traders, when they trade the ranging market, they're going to buy at support, sell at resistance. As a start, okay, trade the bullish market, because you have a nice bullish trend. Yes, this is a currency pair, but then it still applies to stocks, okay? Another way to look at it, when you have a sideways trend at the beginning of a bullish trend, it is called accumulation, okay? And when the trend starts to continue, then it's called an uptrend. And during this phase, you can apply a trend following strategy. At the end of an uptrend, you would have a distribution phase where prices will go sideways, okay? Then right after distribution phase, this is where a bearish trend will be formed, and then price will go down. Of course, not all trends are like that. It depends on the market condition. Because the distribution phase is where the smart money, they are taking profits. Okay, so in the world of technical analysis, there are a lot of price action tools, chart pattern, which can be applied to stocks, gold, commodities, and we also got to pay attention to supply and demand zones, very important, just to find out what the smart money is doing, okay? And as a beginner trader, you just gotta learn the basic candlestick patterns, but once you become more experienced, I need you to learn how to spot the manipulated candles, because market makers, they are going to manipulate prices to stop people out, okay? But that's for maybe another lecture. And then you also have trend lines, pivots, and also Fibo retracement levels. If you want more stock trading course, then you can subscribe to my channel, and then in the future I'll post more on this YouTube channel, okay? So to put in simple terms, when you have a bullish trend, you gotta look for bullish candlestick patterns for you to make an entry. And then when you exit when you see a bearish candlestick pattern, especially at a resistance area, okay? And then when you have a bearish trend, nice downtrend, then you gotta look for a bearish candlestick pattern. You gotta wait for that. Don't just sell whenever you want, okay? Look for a bearish candlestick pattern, particularly testing a resistance zone with confluence, meaning multiple resistance. Not too many, like 10 resistance, 20 resistance. By the time you wait for 10, 20, it's already tomorrow. Bare minimum 2 levels of resistance or 2 levels of support when you buy. And then you cover your positions using bullish candlestick patterns. So you buy back your shares when you see a bullish candlestick pattern testing a strong support, okay? Or a strong demand zone. Now, as a beginner, I don't want to confuse you with the candlestick names too much because it can be quite a lot. If you want to know more, you can always watch my candlestick videos. But to put in simple terms, if you look from the left side to the right side, okay, we are going from the most bullish pattern to the least bullish pattern, okay? Means the first one is the strongest. You see there's nothing here. It's just a full candle body. This is the strongest bullish pattern, okay? But when you have a large candle with a large body, but then it has an upper shadow. If you think about the psychology, the price opened over here, and then it went all the way up to this upper wick over here, and then came back down at the end of the session and closed here. Means that there's a level of sellers that were pushing the price down, but not as much as compared to the last candle, where the sellers pushed the price from here all the way down here. Okay, the distance is longer. Means that the sellers, they're pushing until the price closes at bottom. So if you understand the psychology, you don't really need to learn the name, because the moment you see it, you know, like, okay, this is strong, this is weak, and this is moderate, okay? Okay, then for bearish candlestick patterns, same thing, okay? From the left side going to the right side, the bearish strength is getting weaker and weaker and weaker. So on the left side over here, you have a super strong bearish candlestick, then followed by a second strong bearish candlestick, because you can see that price open over here, okay? Then sellers come in, push the price all the way down here, but then there's a small portion of buyers who managed to push the price up to this level, and hence price close over here, okay? Whereas for the least bearish candlestick, price open over here, okay? Sellers push the price all the way down, then eventually buyers came in, pushed the price all the way up here, and hence the price closed over here. The buyer strength is very strong because they managed to push the price all the way up there. So let me just talk a bit about fundamentals for you, okay? In order for you to understand what stocks to trade, what stocks to short at a particular point in time. So over here I have the economic cycle or the business cycle. So basically the economy goes through a period of expansion, and then you go through a period of contraction. So this is a time where some people will call it recession. Normally over the past 100 years, expansion, it will last longer than recessions. So you can understand that during expansion phase, certain markets, certain stocks, certain currencies, certain commodities are going to go up. And during recession, certain stocks are going to go up as well, and certain stocks are going to go down. So during the expansion phase, when times are good, normally, not all the time, but normally, tech stocks, cyclical stocks, and industrial stocks are going to go up. And normally, during the peak, when the economy is almost at the peak or at the peak, commodities are going to do well. So normally you see oil prices, commodity index is going to go up. And this means that commodity stocks are also going to go up. If you trade currencies, commodity currencies are going to benefit from this. So during peak phase, energy, precious metal stocks are going to do well. And during a recession, certain stocks are going to do well. For example, defensive stocks, meaning consumer staples, utilities, food producers, pharmaceutical firm, especially during a pandemic. But if you think about this, in any recession, when times are bad, we still need to eat, sleep, brush our teeth, shower, and hence all these basic needs stocks are going to benefit. So in a way, you can use the rise and fall of these industries to indicate to you, okay, right now we are in an expansion, right now we are in a recession. But a formal definition of recession is 2 consecutive quarters of negative GDP growth. And during the trough, this is when the recession will bottom. Normally by this time, the stock market index has already recovered. It's already on a bullish trend because normally during the recession, the stock market will already have recovered. Because, like I said just now, the stock market is the leading indicator of the economy. And also bear in mind, during the peak, the late expansion phase, investors and traders, they are going to focus more on interest rates. Okay, right now let's talk about stockbrokers. And basically, what is a brokerage firm? It's a company that's licensed to buy and sell stocks on behalf of its clients. In other words, they are the middleman who provides retail traders and investors access to a stock exchange. So everything is done online nowadays because back in the good old days, in the 90s, I come from a family of stock investors. So a lot of times, my parents, they would have to call stockbroker to buy, sell a stock. Nowadays, we can just click buy and sell, okay? In order to trade and invest in the market, you have to sign up with a brokerage firm. So make sure you take the time to pick the right stockbroker. When it comes to choosing a broker, the most important one, before you look at anything else, the commissions and all that, the fees, make sure that it is regulated by a good financial authority. If it is regulated by some random authority that is not that strict, then it is not a good regulation. Because if the company can get regulated easily, means that they can get away with a lot of things, including your money. Has a good reputation, rapid trade execution, and also good customer service. Email them, call them, and see how fast will they respond to you. If you choose the wrong company, you might have issues with getting back your money, especially when it's not regulated. And also, there might be hidden fees, a lot of hidden fees if you don't read the black and white properly. And also the order will be filled at a price that is not good. And also nowadays, because there are so many scams in crypto, try to avoid brokers that require you to transfer crypto instead of currency, money. Because I realize a lot of scammers nowadays, they have one thing in common is that they like to deal with crypto. So basically there are 3 types of stockbrokers: online broker, full service broker, and discount broker. So basically what is a discount broker? It's suitable for investors and traders who prefer to make their own decisions. Discount brokers were only popular in the early days of the internet. So that's why nowadays these brokers don't refer to themselves as discount broker anymore. They just call themselves online broker or just broker, okay? So nowadays we just call them online brokers, which is most popular among stock traders. Okay, and it's easiest to use but offers little to no investment advice or trading advice. So if you prefer to make your own trading decisions, you have your own strategy, then you can just go with an online broker. But nowadays, you realize that a lot of online brokers, they are starting to catch up with full service brokers. Nowadays, a lot of brokers, because of competition, they also provide you with research, analyst recommendations, and also some even provide you with trading advice. This means that the demand for full service brokers is gradually decreasing, but there's still demand for it because full service brokers, they normally serve wealthy clients. And wealthy is subjective, but anything, okay, this is a mistake. Anything more than 100,000 is considered wealthy client. Okay, so you can opt for this if you need investment advice or you don't have any time to manage your own account. Just be aware that these brokers normally require more time to enter an order as compared to a typical online broker. Even if you're with a full service broker, make sure you still monitor the account, monitor the investment decisions, make sure you give the final approval before the broker makes any trading investment decisions. So if you prefer somebody to handle things for you, you can opt for this type of broker, but then they are going to charge a premium for their services. Alternatively, just put your money with an index fund, because most money managers nowadays, they underperform the stock markets. And there are two types of accounts, mainly the margin account and cash account. Basically, margin, as the name suggests, you can borrow money to buy more shares than you can afford. If you're a beginner, try not to go for a margin account just yet. Go for a cash account. Because if you make money with a margin account, it's good. You double your money, triple your money, but then when you lose money, you not only lose your original investment, but also you still owe the broker another sum of money that is borrowed. Okay, so now we are going to talk about the different types of orders, okay? And there are a couple of order types that you can consider. The first one is market order, and it tells the broker to buy or sell the stock immediately. Okay, so if you want the price right now, if you like the price that the stock is offering to you right now and you want to enter now, then you can open a market order. But then the downside of market order is that you'll be subjected to the risk of getting a price that you don't want, especially when the markets are moving too fast. Okay, and sometimes when you're opening a market order during a high impact event, you will be subjected to slippages. Whereas for limit order, let's say if the price is right here right now, but you want to enter at a lower price, then you can enter a limit order and tell the broker, okay, execute my trade only when the stock reaches this price. So if you place a limit order to buy, let's say Microsoft at 120, your order will be filled only if the seller is willing to part with their shares at that price. So basically, if 150, for example, is too high for you, then you can put in a limit order to enter at a better price. The thing with limit orders is that it's not guaranteed that your trade will be filled, but it's guaranteed that you get a better price. Whereas for a market order, it is guaranteed that your order will be filled, but then chances are you won't get a good price. Whereas a stop order is used to limit your trading losses. Basically, it's what we call a stop loss. And when you enter any of these orders, you will have a separate option where the broker will ask you, okay, do you want a day order or GTC order? Basically, if you pick a day order, the order will be executed when the market closes. Whereas for GTC order, it will only be closed once the price has reached your desired price. So when you have a GTC order, you have a greater chance for your order being filled because it's going to remain open until you cancel it. So that's why GTC is called good till cancelled. And also you gotta take note that brokers normally they will charge a higher commission to fulfill a limit order as compared to a market order. So personally for me, I'll often use limit orders because a lot of times I want to enter at a better price, and then my stop loss orders and then also my target price limit orders will often be GTC. Okay? Because if you don't cancel it, it will always be there for GTC. But some brokers, they will automatically cancel a GTC order after a certain period, like a month or more than that, if it has not been filled after a certain period of time. So you gotta check with your broker to find out their cancellation policies and all that, okay? Basically with GTC, why do I use it more often is because it has a greater chance of being filled as compared to a day order. Okay, so when should you place your orders? So you can understand that the trading hours for the US stock market is 9:30 a.m. EST to 4 p.m. EST. So some brokers, they will let you trade stocks in the pre-market trading session, meaning from 4 p.m. to 9:30 a.m. EST. or in a post-market trading session. So if you place a limit order, you can trade before the stock market opens. So a lot of times, I will place my orders even before the stock market opens. Same for a lot of traders, because they already know the price that they want, the stock that they want, so they just put in a limit order. You don't have to wait until the market opens for you to enter a trade. Okay? In fact, I would say most of the work is done when the stock market is closed. Just remember that when you're going to trade before the market opens or in the after hours of the market, always use a limit order. And also remember, if you're a beginner trader, don't ever trade an IPO using market orders. Okay, let's talk about indices and ETFs. So basically, what is an index? So index is just a singular form because the plural form is indices. So when people talk about indices, then index is basically the same thing. It represents a basket of stocks. So if you're somebody who is busy, you're studying and then working full-time, you have no time to research for individual stocks to buy, then you can just buy an index. One of the most popular index, S&P 500 index, okay? Basically, it's an index with 500 US stocks with the largest market caps. So in the long term, the S&P 500 will go up no matter what because of inflation and because of the fact that when there are bad companies that are not performing, then it's going to be replaced by better companies. Of course, in the short term, it might have retracements, okay? But in the long term, it's still going to go up. Other well-known indices include Dow Jones Industrial Average and Nasdaq. Basically, when you buy index funds, ETFs, you have a money manager to manage everything for you. Just that a lot of times when economy is doing well, most individual stock pickers will get better returns on average as compared to somebody who just buy the index and then hold it long term. But if you're somebody who has no knowledge on the stock market and you want to participate in the stock market without putting in too much time, then you can consider ETFs. So basically, if you go to tradingview.com, this is the ETF that you can buy, and the long term is going to go up, okay? And especially during a recession, when it plunges, it's a good time to get in. It has always been that way for 2020 recession, for 2008 recession, for the past many recessions. And you can check the company that is inside this index from this website called slickcharts.com. So if you are worried or somehow curious about, okay, what is inside the ETF that I've just bought, then you can go and check which are companies that are included. Okay, so you can see Apple, Microsoft, all the big caps, Amazon, Nvidia. In fact, all these companies up here are leveraging on AI. Okay, they are going to benefit from AI because they use a lot of AI in their technology, a lot of machine learning technology as well. At the end of the day, don't trust anybody, do your own research. So basically, ETF is just like a stock, just that there are 500 companies inside. Whereas for Dow Jones Index, the ticker symbol is DIA. And again, if you want to check the weightings of Dow Jones, you can go to Stick Charts. And then you can see there's United Health, Goldman Sachs, Home Depot, McDonald's, Visa, a lot of big caps too. And then for Nasdaq, the ticker symbol is QQQ. And for Nasdaq, it is mainly tech stocks, okay? Mainly tech stocks. And you have the big companies again like Microsoft, Apple, Amazon, Nvidia, Meta, Tesla, PepsiCo, Cisco Systems, alright, so on and so forth. Alright, so let's talk about how to find stocks to trade, how to filter out stocks. So I'll need you to write down this trading plan, step-by-step trading plan, so that you know the sequence that you should follow for you to generate an idea and eventually buy a stock, okay? So this is the bigger picture plan. The first thing you need to do is, of course, to generate an idea. There are a couple of ways to generate ideas. I'll share with you later on, okay? Then the next step is to use a stock screener to filter out great stocks. Of course, if you want to skip to this second step, it's fine because this also gives you ideas. Alright, so the first step is optional. This one's optional. You can skip to number 2 if you want to. If you want number 1 and number 2, follow properly is also okay. Then number 3, you create a watch list. Basically, you create a watch list when you find a stock you like that meets your criteria, but the price is just not right yet. Let's say Microsoft, it fits all your fundamental data. You checked out the management, everything is okay. But when you look at the stock chart, the price is right now too high. You want it to come down. So you put it into the watch list. Okay? We don't trade it first, we put it on the watch list. And then after that, we gotta wait for a trading signal. And very often we will use a price action confirmation with confluence to enter. Okay, so how do you generate ideas? I'm going to give you a couple of ways you can do that. The first one is think of products that you use regularly. Just go around your house, look at the stuff that you have. Chances are, especially if you're Asian, you might tend to use the same thing, like Clorox to clean your house, and Coca-Cola, we all drink that, you know what I'm saying? If you really can't find any ideas, then you can use this most conventional method. If you're just like me, you like to go shopping, you can shop and then so-called make money at the same time. Because while you're shopping, don't just go and shop and then have fun, but then also pay attention. Which shop has a lot of customers all the time? So when you see a shop that has a lot of customers, then go online and check whether are they listed on the stock exchange. So in Singapore, I realized that a lot of times I walk past the Apple store, it's always full of people. But if you don't like these conventional ways, then you can skip to step number 2, which is to use a stock screener. Now there are a couple of stock screeners that you can consider. The most simple one, if you are too confused by all the finance terms, then you can start with this as a beginner. Yahoo Finance has a stock screener. And why is this for beginners? Because I feel that it only has very few filters. So you can start with this. Okay, I want to filter out large cap stocks, the more liquid stocks. But once you have learned all the terms and all that, then you can go to more advanced filters. The next stock screener you can consider is Market Watch. This is also suitable for beginners because it's not too complicated, but then I would prefer something more specific, okay? So if you are more of an intermediate or expert trader and you know all the terms already, then you can filter out using Market Chameleon. The good thing about Market Chameleon is that it tells you whether the stock is currently on an uptrend or crossover. So it's very useful for you if you don't know how to spot trends. Is this stock on an uptrend, downtrend, going sideways, okay? But personally, what I like to use is Finviz. Okay, Finviz, because they have very specific filters. And just bear in mind that even though you have all these criteria and filters, you don't have to use everything, because if you use everything from the descriptive tab, fundamental tab, technical tab, by the time you filter everything, okay, you have like 100 criteria, then you're going to get no stocks to trade. You know what I'm saying? So I would like to have a good amount of criteria, but not too many, but also not too little that you only have 1 to 2 criteria. You know what I'm saying? It's not enough. So the most important thing is to make sure that you filter out liquid stocks to trade. So you gotta filter out using average volume and also relative volume. So later I'm gonna share with you how to filter out what criteria to put in. Okay, right now let's talk about a very simple trading strategy that even beginners can use, okay? So there are a couple of stock trading strategies that you can consider using. The first one is trend trading. Basically, when it comes to trend trading, you are trading along with the trend rather than against the trend, okay? So what we want to do is that we want to wait for the trend to retrace, and then we can enter on a good price before the price goes back up, okay? So some people will call this retracement trading, and this is very suitable for beginners. And the second trading strategy that you can consider is momentum trading. Now this is more suitable if you are an experienced trader, because for momentum trading, traders would often buy high aiming to sell higher. Okay, so we are buying high, selling higher, or low aiming to cover lower. So why is this more suitable for experienced traders? Because very often times the risk to reward is not as desirable as compared to retracement trading. Okay, retracement trading. And whereas for counter trend trading, again, is more suitable for experienced traders because we are trading against the trend, and oftentimes we want to wait for a recession to come. When the price is on a downtrend, we want to enter at a low price, hoping that the trend will U-turn and reverse and recover. So in a way, you are buying in a bearish market, which is more dangerous as compared to trading along with the trend. So if you want to increase the probability of your trades, then you can start with trend trading, okay? Then when you become more experienced, then you can add momentum trading and counter trend trading as part of your trading strategy. So let's talk about trend trading for now, or retracement trading. Basically, like I said, you're trading along with the trend rather than against it. And how do you determine the trend? You can use the stock screener that I showed you just now. Market Chameleon can tell you whether the stock is on an uptrend or downtrend. Or you can just use moving averages to determine the trend. Okay, I'll show you a quick example later on. So for this trading strategy, you gotta follow this trading plan step by step. Okay, so to pick a stock to trade, a good stock to trade, the first thing you gotta ensure is to make sure that the S&P 500 is bullish. The overall stock market is bullish. So we are looking for a buy trade, okay? We are looking for a buy trade right now. Once the first criteria is fulfilled, then you move on to second criteria. You want to trade liquid stocks, meaning high volume stocks. So you want to go to your stock screener and make sure that the average volume is more than 1 million, relative volume more than 1. Once this is fulfilled, then you need to go to this website, Investors Business Daily. For a small subscription, okay, this is not sponsored, for a small subscription fee, you can determine the relative strength of a stock. So this relative strength is not your RSI, not relative strength index, but relative strength. It gives you an idea of the strength of the stock as compared to a benchmark. So if your stock has a high relative strength, let's say more than 80, it means that it is currently more bullish than the overall index. So if you want super good stocks, if you're more conservative, then you can look for stocks with relative strength of more than 90. Go to IBD website and then you can see the relative strength of the stock. And once it's fulfilled, you want to make sure that the stock is in a growing sector. You can go to Finviz and then filter out. Later I'll give you an example, show you how to find growing sectors. And then you can look at the stock chart itself of that individual stock. Make sure that the stock is in an uptrend, and in order to enter a trade, you use price action confirmation with confluence. Let's say this criteria is fulfilled, this criteria is fulfilled, and you want to see whether the stock is in a growing sector. Okay, I want to give you an example of a stock I bought that generated good returns a couple of months ago. Before I bought this stock, I checked the growing sectors. Now this is from Finviz. At that point in time, the one-day relative performance. Consumer cyclical technology stocks are growing, and on a weekly basis, technology stocks are doing well, communication services stocks are doing well. You can filter out technology stocks. Okay, so that's what I did. And then I came across this stock called Analog Devices. It gave me a bullish confirmation. And how do you know whether the stock is in an uptrend? So what you want to see is the 50 SMA. You see this yellow line? 50 SMA is above 100 SMA. 100 SMA is above 200 SMA. Okay? And ideally, it has to be tested before. So because I'm a more conservative trader, I want a good risk to reward ratio. So I want to wait for the price to come down and test 200 SMA. Of course, it might bounce off 100 SMA over here, but the risk to reward wouldn't be that good as compared to if it tests 200 SMA. Okay, so this is just me. And at the same time, remember when I said confluence, you want to make sure that it is testing a very strong support zone. So you can see over here, resistance became support. Agree with me? Coupled with candlestick confirmation. I've already done a lot of candlestick videos. This is a good place to enter. Okay, so my stop would be here, looking to TP at around 190. And sure enough, it went all the way up to 190. Okay, before it retraces. So that's a good risk to reward ratio Entry being here, stop, and then TP. So another stock that I bought is this company called Dick's Sporting Goods because it's under consumer cyclical. It is one of the top 2 growing sectors on a daily and weekly basis. So you can see the moving averages, they are above each other. 50 above 100, 100 above 200, okay? And make sure that these moving averages, they're sloping up. Of course, if the 50, 100 is sloping up, 200 is going sideways, is still okay. And then we wait for price action confirmation over here. So this is showing me a bullish candlestick pattern, and the resistance here became support. You see that? I'm looking to TP at around 150. And wait a couple of weeks, and you can see, sure enough, it reached slightly beyond 150. Okay? And we earn a good 8.35% from it. And the good thing about this stock is that it also pays dividends. Okay? So we got 2 sources of income, the capital gain as well as dividends. I bought a lot more stocks, but these are just 2 examples, good examples to show you. And also another technology stock. This one, there's a resistance trend line over here, so the risk to reward is not as good as the previous 2 trades I've made. Okay? But still, we made a good 8.32% return. And of course, there are a lot more criteria that I look at before I pick stocks. If you want a more detailed lesson, let me know. And also, if you found this free course useful, share it with your friends and family, subscribe, because I put in a lot of time and effort to make these presentation slides. And also now that I have a second study channel, that has become my main channel. And if you can show more support for this channel, then I'll put more focus on this channel. And if you have any questions, you can always email me, but please remember that I'm not on Telegram or WhatsApp at all. I don't provide free signals. If you go there and see my name there, those are all fake accounts. I don't provide account management. I won't go around messaging people, telling people to send me money. Those are all fake accounts. I won't go around following messaging people. And if you want to learn about stock investing rather than stock trading, I'll put a video that I've made somewhere on the screen right now, so you can check it out. So with that, enjoy learning. Bye.